Well, the market has done exceptionally well over the past several months, and I think that it's questioning whether it needs to digest some of the recent gains or not. It's looking toward the turmoil in Washington, D.C. as a possible reason, combined with valuations, the distance away from moving averages, et cetera. So I think in general, investors are trying to weigh the short term concerns versus the longer term expectations for a recovering global economy. I think it really hasn't been reacting very much to it as we've been seeing the market rise as a result, even though we've had all of this turmoil that's been going on. I think you're absolutely right that what is going on in Washington, D.C. makes for better headlines than it has effects on bottom lines. But there still is a weak plus, and there still is a worry that the president could decide to do something to voice his frustration, if you will. If he can't do it on social media, then he might do it simply through actions. And it's the uncertainty that is causing investors possibly to worry a little bit. Or maybe it's simply a reaction to many strategists who are saying that we have reached peaks and that we're likely to see some sort of a correction. So maybe it ends up being a self-fulfilling prophecy. So Wall Street is always trying to climb that wall of worry, and right now it's adding to that wall. The dollar is traditionally a safe haven for investors. So if there is concerns on a global basis, then investors do gravitate toward the dollar. They gravitate toward the Japanese yen and the Swiss franc. In terms of Bitcoin, it is a highly speculative area that sort of fluctuates on the whims of investors. So my concern would be more on your traditional asset classes, equities, bonds, gold, et cetera. I think a big concern is higher interest rates. If the U.S. is beginning to offer greater interest rates than it was before, it makes it more attractive to yield-starved global investors who are looking for opportunities elsewhere. So I think that the improvement in the yield on the 10-year note is probably more likely what is causing the value of the dollar to strengthen. Expectation that we could see a pickup in consumer demand by the second half of this year, and therefore a pickup in overall economic activity, which should push up earnings, et cetera. So I think that investors, whom I always like to regard as being similar to hyperactive first graders playing musical chairs, always trying to out-anticipate the other, are trying to find out, okay, well, when will inflation start to pick up? Because if we do expect to see pent-up demand be satisfied in the second half, then that would push up prices. So Wall Street, in a sense, is getting ahead of what it thinks will happen in the second half of this year. Well, the expectation is because of the blue ripple, as I call it, that there is a greater likelihood of additional stimulus actions brought forth by the government, in addition to the continued easing, if you will, or just easy monetary policy. So I think that investors are expecting that we are going to see an improvement in economic activity in the year ahead. So really, it's the Democrats being in charge who are likely to push up the spending. I guess we'll have to wait until later to see whether they push up the taxes as well. I don't think that it's going to have at least a long-term serious sell-off. We could see a very sharp pullback, which is a 5 to 10% decline, or maybe even a shallow correction, but I don't think we're going to be falling into a new bear market. We need to see, however, economic growth and earnings forecasts improve as the year progresses, because right now we're trading at 24 times forward PEs, which is actually more than a 45% premium to the average PE since 1999. So you can't ignore expensive valuations for too long.